Hey there, future financial wizards. Captain Cash reporting for duty, ready to unleash your financial superpower.
And I'm Professor Penny, here to decode the mysteries of money with logic and precision.
Before we dive into the calculations, let's understand the core idea behind VAT, or value added tax. It's a consumption tax, meaning it's charged on most goods and services we use. Think of it as a small tax on every step of a product's journey to the consumer.
That's right. The key is that tax isn't just paid once, it's paid at different stages of production and distribution, but the final burden falls on the end consumer. To make this work, the South African government uses three main types of VAT.
The most common type is standard rated VAT. This is the 15% that applies to most items you buy every day. Businesses charge this on their sales and pay it to SARS. You'll find this on things like clothing, electronics, and restaurant meals.
Now for the good stuff. Zero rated VAT. This means the VAT rate is 0%. You pay no VAT on these items. The government does this to help make basic necessities more affordable for everyone. Common examples of zero-rated items in South Africa include international transport services, basic foodstuffs like brown bread, maize meal and milk, as well as paraffin.
But do these products still fall under the VAT system?
Yes, businesses that sell them can still claim back the VAT on their own expenses. This is a crucial point for an accounting student.
Finally, we have items that are exempt from VAT. This means they are completely outside of the VAT system. No VAT is charged on the sale, but businesses also cannot claim back any VAT they paid on their related expenses. This category often includes services and products considered to be in the public interest. Examples are public transport, educational services, financial services, and residential rental income. Let's simplify VAT using a quick mental model. Think of any product's price as having two parts, the original cost and the VAT. The original cost, also known as the VAT exclusive amount, is always our 100%. If a store buys a laptop for 10,000 Rand, that's the 100%. That's the core price of the product. Now, when the store sells the laptop, they have to add the VAT. In South Africa, that's the 15%. This is the tax they collect for the government. So, for the customer, the final price is the VAT exclusive amount plus the VAT amount. That means you're paying a total of 115% of the original price. So, that 10,000 Rand laptop now costs 11,500.
The next template and calculations will help calculate the amount of VAT payable to SARS. The amount payable to SARS is typically on the credit side of your VAT control account. But if it is found on the debit side, the amount is receivable from SARS. Thus, VAT input is on the debit side because it is receivable from purchases, and VAT output is on the credit side because it is charged on sales. VAT input amounts from journals include your cash purchases journal, creditors journal, petty cash journal, and general journals debit side. VAT output amounts from journals include cash receipts journal, debtors journals, creditors allowances journals, and general journals credit side. Other transactions included in your debit side of the VAT control account is the VAT amounts of discounts allowed and bad debts. Furthermore, other amounts included in the credit side of the VAT control account is the VAT amounts of discounts received, bad debts recovered, drawings, and donations.
Now hold on, don't go yet. Stay with us for the last and final calculation of VAT. Our opening balance is found on the credit side of the VAT control account and consists of 31470. Next, we draw for ourselves the VAT control account. The credit side is for all our VAT output. This is the VAT we've collected from our customers. Just look at the spreadsheet. Total sales amounted 80250. This is the biggest one. It's the VAT we charged on everything we sold. The money came from our customers, so we owe it to SARS. Discounts received amounted 1725. If a supplier gives us a discount, it means we paid less for our goods. So the VAT we claimed back was also less. This makes the VAT we owe SARS a little bit bigger. Stock taken by owner amounted 1440. When the owner takes products for themselves, they're not a customer paying VAT, so we still have to pay the VAT on it ourselves. It's like a personal purchase. You can see all these amounts are on the right side, adding to the total we owe SARS.
Now for the good news. The debit side is for all the VAT input. This is the VAT we've paid to other businesses, and we can claim it back from SARS. Purchases of inventory amounted to 57750. This is the VAT we paid when we bought products to sell. Since we're not the final consumer, we get to claim this back. Goods returned by debtors amounted to 3375. When a customer returns something, we refund them the VAT, so we no longer owe that VAT to SARS, and our debt to them is reduced. Accounts receivable written off amounted to 4800. If a customer never pays us for a sale, we never actually received the VAT. We can't owe SARS something we never got, so we write off this amount and reduce our VAT debt. See how all these amounts on the left side reduce our total debt to SARS?
To find the final amount, we add up both sides. The total of the transactions on the credit side is 114,885. This is our total debt to SARS. The total of the transactions on the debit side is 65925. This is the amount we can claim from SARS. The difference between the two sides is thus the final answer. Look at the closing balance on the left side, which amounts to 48960. This is the VAT amount payable to SARS. We had to put it on the debit side to make both sides equal, which means our VAT output was bigger than our VAT input, so we owe SARS money. In simple terms, after all our buying and selling, we collected more VAT from our customers than we paid to our suppliers. The difference is the amount we have to pay the government. And that's all a VAT control account is, a tool to find that final number.
We've covered a lot today. Remember, for a non-accounting student, VAT is just a tax. But for you, as a future accounting professional, it's a critical part of financial management.
You're the one who must keep track of the VAT outputs you collect and the VAT inputs you can claim. The VAT control account isn't just a part of the lesson. It's a real-world tool that can reconcile a company's tax position.
This understanding will be what sets you apart. The ability to manage these transactions and balance this account is essential for ensuring a business is compliant and its financial records are accurate. We hope this video has given you a solid foundation for your studies. Thanks for watching. Keep those journals in order and that ledger balanced. You've got this.